Well, good afternoon, everybody. Welcome to the September 20th. We're very close to the autumnal equinox. Good afternoon and welcome to all you investors. My name is Mark Robertson. I'm joined here by Ken Kavula. How are you today, Ken?
I'm doing real well, Mark. We're babysitting today. I'm not used this body is not used to chasing a 4-year-old all around. So other than that, things are going pretty well.
Well, all of us are babysitting Jerome, so without any further ado on that, we'll just let that slide.
Okay.
I'm not sure if Kim's with us or not yet. She's going to try to join us. But Matt Spielman also is checking in from Houston. Good afternoon, Matt.
Good afternoon, Mark. Good afternoon, everyone. Are we recording, Mark? My panel still says start recording. I didn't want to push it myself.
I thought that I did. And thanks for asking. I do have the record button pushed. All right, so today we're going to talk a little bit about grilling, a little bit about Jerome, a little bit about guardians of quality in the name of and form of one Matt Spielman. And Ken is going to sneak in with a couple early nominations for the board for our best small companies. Anything else you'd like to kick around at this point, Ken?
No. Let's just get started.
All right.
Okay.
I do want to give the advance warning that I still have huge construction equipment just across my property line in the backyard, and sometimes when they move, my internet mysteriously goes away. It happened this morning, so forewarned, and we'll just do the best we can. All right, here is our standard disclaimer. No investment recommendation is intended. This is entirely about the demonstration and education. We're basically here to talk about some stuff which has worked for the better part of 8 decades, helping people to discover and study, analyze, and like a good steward, own companies for as long as it makes sense to do so. So we're going to basically be sharing those philosophies and techniques and methods here today. The views that you hear will be our opinions. Please do your own homework before making a decision about any particular investment. If we hold a position in anything that we talk about, we'll try to remember to disclose that. We're a week out from our roundtable, which is our monthly webcast where we share 4 or 5 ideas and actually walk through that specific analysis for those 4 or 5 ideas. The roundtable tracking portfolio stands at about 15 or 16% annualized rate of return since 2010. So the stuff that we have kicked around as a community of investors has done fairly well for a number of years. If you'd like to be added to the reminder list, it's just an email reminder list for that particular event. And I think we also use it for some of the other conference type events that we do. Please send an email to nkavula1@comcast.net. If you'd like copies of the slides, if you have follow-up questions or suggestions for future topics, you can reach either of us at those 2 email addresses at the bottom of the page. Anything else, Ken?
Nope. It's a good wrap up to start the whole process with. So let's see where we're going today.
All right. We like to start here. Our general reminder about the reality that stock prices fluctuate. We know this. The green bars are the stock market as measured by the value line arithmetic average. They basically zig and zag. They are steadily increasing from left to right and not in a linear fashion. That blue line is a trend line through those green points over time. So it's just a simple mathematical regression provided by Excel. And we just like to point out that we spend time below the line. We spend time above the line. We spent quite an interesting couple of years above the line from until COVID hit. And right now we're in the midst of what I've taken to calling, at least for the last few days, the Jackson Abyss. I've upgraded from Jackson Hole to Jackson Abyss. And can't blame Jerome Powell for everything, but obviously the Fed is cranking down pretty much and it is tightening things down in the equity markets. So, the one thing that I do see that's a little bit concerning, I don't know how widespread this is yet, time will tell, is even with the drop in stock prices, we have had a reduction in return forecasts. The only way that can happen will be if fundamentals are easing up. That would mean that the rhinos, the institutional analysts, are basically backing down on some of their projections, easing up on their projections a little bit. They usually overdo it. Ken likes to point that out every time they do. Your thoughts, Ken?
Well, that dot is still above the long-term average, Mark. So, maybe it's just reverting back to the mean where it normally where it doesn't stay for very long. It looks like it rides above and below that 10% line most of the time, but it's still above average at the moment. It looks like it's maybe 12.5. Is that what the number is at the moment?
Yeah, it's right just above 12.
Yeah. So, and the average is somewhere, we know that the average is somewhere between 9.5 and 10.5, depending on how you measure all the stuff. So, I'm not especially concerned by it moving into that direction at the moment.
I'm not either, just observing that if they did catch some type of an ailment or affliction where they got overly optimistic or overly enthusiastic by what we saw, back during this period, maybe some of that fluff is coming out, and that's not all bad or inaccurate. But back to the blue line. Here's a look at the value line arithmetic average using stockcharts.com, going back 1 year. Again, just making the point that we're basically a threat to roll back to these lows that we saw back in June. That wouldn't be the end of the world, despite what you hear on TV. And we're actually fairly close to that now. And at least the 50-day moving average is in an uptrend now, and so we can continue to hope for continued strength. And this, by the way, was the day that I went on vacation, right there. All right, and then another quick look that just demonstrates that we are in something that does have statistical significance. What you're looking at here is the number of new highs versus new lows. That is the green and magenta or brown or whatever you want to call it, zigzagging trend there. The blue is the long-term 12-month moving average that we have used just to kind of keep track of that. And you can see that these levels are now, we basically are back at levels that resemble that tough time back in 2008, 2009. And all that says is that more stocks are hitting new lows than new highs in a volume that we haven't seen very often here over the last 20 years.
Excuse me.
All that basically does is says just be careful out there and focus on quality. The shaded area here is the S&P 500 playing in the background. So again, I think the message always is invest regularly, but part B of that message is maybe ratchet up your quality requirements, perhaps financial strength requirements right now. That's no different. Okay. Just our Jerome Powell moment for the afternoon. We've got a couple here. Some people that are very prominent out there, including Ken's favorite TV station, CNBC, have been a little bit critical of Mr. Powell. And then this one here I wanted to point out there, but I didn't actually finish reading it. This was in the Wall Street Journal yesterday. And it basically explains what he had to say out in Jackson Hole. And a lot of people are looking at it and just kind of questioning the approach and, why weren't you going sooner and all that kind of stuff. I don't know. Did you get a chance to look at this one, Ken?
No, I didn't, Mark.
Basically accusing him of channeling Paul Volcker and trying to tighten down, much like they did in the early 1980s, after a fairly rough 1970s period. And, some of the articles have actually been fairly critical, fairly harsh. You guys have yelled at me for being too mean to Jerome. But the consensus from many of the people who have watched the stuff for a long time are, one, remember what's important. 2, measure it, and 3, act on it when you see that it needs to be acted on. So hindsight's 2020, I guess. All right, here's our Twitter moment for the week. You want to be careful using this at the neighborhood barbecue because you don't want to be tagged as a know-it-all, but this is one that I found a little bit surprising, and I thought all of you might also. Again, from Twitter, and it's not a condition that I was actually aware of, but there's been a lot of talk over the last couple of decades about the amount of ownership of U.S. Treasuries by China, and the graph kind of speaks for itself. This is not something I knew. Is this something you were aware of, Ken?
I have heard this fact in a number of different forms for 5 or 6 years, Mark. I've heard the fact a little bit less starkly that the percentage had been declining on a regular basis, and obviously that's what the graph shows. I didn't realize it had gotten down to about 4% now of the total Treasury holdings. So I did know that it was double digit at one time during the financial crisis of 2008, 2009. So this is a very interesting chart, and it just goes to show what used to be common knowledge is not so common, and maybe it's not even knowledge anymore. So,
and certainly not accurate at all times either. So it's just another. I was reminded that a couple of years ago we talked about the book Factfulness, and there have been a couple other books that we've talked about lately that remind that it's always a good idea to check when you hear somebody, because I guarantee you within the next month or so somebody will be on TV, a talking head, whining about China and the amount of ownership of U.S. securities for treasuries.
It's amazing how many of these so-called facts, Mark, if you try to track them back, you track them back to a single article or a single event, and you find out that the initiator of the data point is maybe not held in such high esteem anymore as it was when the data point was announced. I think that data point about oh boy, I'm going to get myself in trouble now, but the data point about how much women make compared to how much men make, I think
you are on thin ice now.
It's quoted every time that we talk about economics, and yet if you trace that one all the way back to where it comes from the beginning, it comes from a study whose data was withdrawn for being flawed in the first place. So it just, some of these common everyday facts get their life from just being repeated time and time and time and time again by journalists that should know better.
Yep. And I beat up on the journalists enough in my social media stuff, so I'll leave them alone for the rest of the afternoon, as best I can anyhow. All right, just thought we'd have a little bit of fun with the dashboard here. This happens to be a quote, again from Twitter. Compounding quality is the individual or institution, and Bill Ackman is somebody that we have had a little bit of fun with over the years. Bill got involved with that fantastic skirmish with it's escaping me now, but it was definitely a roll in the hay, roll in the mud, punches were thrown battle a few years ago. So he has provided entertainment. He actually runs Pershing Square Fund, and I just thought we'd take what he's quoting there and see if it measures up very well. Pershing Square is a very concentrated hedge fund. Those are all 8 holdings. They had fairly recently sold Netflix, and they have also fairly recently divested their Domino's pizza position. So I guess movies and pizza are out. These stats actually come from InsiderMonkey.com if you want to read about their thoughts on these companies, but just want to kind of make a point of, this is free. If you go to InsiderMonkey.com, you can register for free and look at this kind of stuff. But just kind of ask the question, well, first of all, are those high quality businesses? So we throw them on a dashboard. And you see this rather large in terms of dollar dashboard pointing out that, they're pretty good, but they're not across the board extremely high quality, is the statement. And I think this is just kind of a fun exercise to do, looking at this kind of stuff. Anything jump off the page there, Ken?
Yeah, what jumps off the page at me is 3 out of the list being basically restaurant stocks, and I've always had almost an irrational fear of dealing with restaurant stocks. I just find that the public is so fickle when it comes to these stocks, and it's a darling one day, and it's avoided by everybody the next year. And I mean, you have Chipotle and Restaurant Brands and Domino's, 3 of them out of a very short list being focused on a single industry. I just find that troublesome's not the word. Curious maybe is a better word to explain what's going on there.
Well, we've talked about this before. I mean, it was just a few short years ago that we had tremendous heartburn, no pun intended, over Popeyes being added to the best small company list, and the company has since been bought out. But that Popeyes proceeded to be our top performing company that year. And a couple years ago, we had a couple of the wing companies in there, Wingstop, and the other one escapes me. And again, we had that heartburn, and they actually turned in pretty good results too. So, it really is a kind of an open mind question, but you don't have to own them forever. But if the opportunity presents itself, Chipotle has really been through a roller coaster over the last few years, and they appear to have a pretty good product based on the long lines I see every time I drive one and buy the one in our neighborhood. All right, so good clean fun there. One of the other things I wanted to point out, that if you find somebody like this, and even if you disagree with some of the way he behaves as a talking head, that's up to you. But what you can actually do is access some fairly decent thinking on companies like this. And this is kind of the view from 35,000 feet, but he's giving you a case study where, describing why they walked away from Netflix a few months ago. And that it basically has to do with the fact that they are going to begin tracking the sharing of passwords and all that kind of stuff, and raising their prices a little bit, but all that kind of stuff. But some real detail on how they think about it, and the willingness to admit mistakes is also a pretty good thing. And, why would we listen to somebody like this? Bill Ackman at Pershing does actually have a really nice track record going back over the last 20 years. A relative return, as we would describe it, of about 5.8%. That's actually pretty outstanding. So again, for the companies that he holds, you can go to a link like the one here and actually look at a fairly detailed analysis on some of these type of companies. So what I find it kind of interesting to do sometimes, as basically in a stock watch mode, just be aware of it and watch for the type of stuff that he might be writing about Lowe's or Chipotle, etc. So it can be a learning opportunity and a resource. Somebody along for the ride that is willing to share some thinking. All right. Anything else on that, Ken?
No, I'm just I'm asking myself why I would look at a hedge fund that any hedge fund, if they can go through a 4-year period with negative returns, 15, 16, 17, 18, those were pretty good years in the stock market, weren't they?
Yeah, some of these guys are very contrary. So, it can be, yeah. Again, I think of it in terms of just exposure to some thinking, and that doesn't mean the thinking's always right.
Yeah.
And maybe understanding what doesn't work sometimes is valuable too. Again, what it all adds up to in the end is also pretty compelling over the most part.
It might be interesting, Mark, to come up with some people's definition of what exactly a hedge fund is. I've heard so many definitions of how you should think about these funds, and I mean, the most simplistic is that a hedge fund is supposed to give you balance against the regular stock market, but then it goes on from there, and you have all these huge funds with these enormous amounts of money sitting in them. I'd like to maybe it'd be a nice exercise to come up with 4 or 5 definitions coming from the fund managers themselves as to what exactly their purpose is and what they're looking to try to do in the long term.
Yeah, Insider Monkey can be most helpful with that. We can take a look at that. I've spent a fair amount of time, in fact, with some of these people. So, you know, a hedge fund is really nothing more than a private investment. Many of them are just stock or equity based. Others will actually have the capability and emphasis on shorting, betting against stocks. So
And a lot of them, you don't have the option of just being open to the entire general public either. Is that right?
well, yeah, and it's the accredited investor thing kicks in.
Yeah.
And, yeah, we can take a closer look at it. And there's hedge funds that do all kinds of stuff. In fact, not hedge funds, but there are 2 exchange traded funds which they're working on right now that are based on the insider trading done by Congress. I don't know if you caught those articles today, Ken.
No, I didn't.
So you can buy one that focuses on the Democrats and one that focuses on the Republicans. It's just, I don't know. Maybe we'll have that when we do our single stock ETF session here.
Are they going to be? I'll make a snarky comment. Are they going to be managed by spouses of congressional folks, or
The literature that I have read actually includes family references. That's all I'm going to say.
Oh dear.
Other than to say that the Democrat ticker is Nance, N-A-N-C.
Oh, okay, let's move on to the next slide.
We need to move on quickly. All right, here's just a really quick before we dig into our stack topic here. Here is the Groundhog Standings. Again, keep in mind that these are real-time adjusted for dividends, so they will be slightly different than the web page at Manifest Investing. Eventually, they will both end up at the same place on Halloween, but on Groundhog Day. But a little bit of moving around here. Some new names, including our dear colleague Kurt Kowitz, moving up into the number 4 slot, nipping at Herb Lemkool's heels, and some other people that have been in the top 10 or near the top 10 all year long. What do you see here, Ken?
I just applaud anybody in the top 30. I just think that this has been an especially brutal year for stock pickers, and isn't that amazing that you can applaud somebody that's only lost $150,000 out of their million to this point? So let's move on. But it's just it's not a pleasant time to be an investor, and it takes a certain sense of humor and a certain ability to compartmentalize if you're going to stay the course and try to be a regular investor in the market. I want to give so much credit to the folks in the investment clubs that I belong to that I haven't noticed any real panicky kind of stuff yet in any of the clubs. I've noticed some discussions that get a little strident occasionally when we're looking at a company that's gone down 30 or 40% from its highs, but nobody bailing on the clubs yet, and in fact gaining members in 3 of the 4 clubs that I belong to. So I want to give them all the credit in the world for understanding that you can't make money if you're not invested in the market, and to pull out of the market and sit on the sidelines is a recipe many times for just failure to thrive.
Yeah, we didn't discuss this earlier, but maybe this is all another topic for one of our sessions fairly soon. We put out that session in March of 2020 about the chasms and what to watch out for, and that turned out to be, even though we were scratching our heads and throwing salt over our shoulders and knocking on wood at the time, it turned out to be a pretty nice session. I think back to the throwing of the towels article that I have published a few times on the website, originally published at Better Investing Magazine, that pointed out how wonderful the 1970s were for people that were becoming familiar with the investment club movement back in those days. And we might be going through one of those again. I mean, same as you can, I look at this list and there's only one participant, and he invests kind of weird, over $1 million. People like Sean Mace down at number 21, he was above $1 million a few weeks ago. It's just a wild market, but when I watch our community of investors, I'm stunned and happy. Basically almost a fireside warmth to watch them navigate these challenging times. And maybe it is time for another conference. I don't know. Featuring that subject. All right. To be further discussed. All right. Speaking of challenging markets, this one give you any nausea these days, Ken?
It's nothing is immune in this market, and the small stocks seem to be acting just as badly as the large stocks. In the case of all those double-digit negative total returns, you might say they're acting even worse than a lot of the large stocks are acting right now. They're certainly not matching what the market is doing. The graph does tend to magnify the differences a little bit because the scale is by hundreds of dollars, but at the same time, it's sitting right there in pretty colors. The red bar is shorter than the green bar. And even if you say, well, let's actively manage the portfolio, it doesn't give you much of a leg up to be able to say that spending time agonizing it over it during the year makes that much of a difference.
Yeah, I would agree. I mean, we've pointed out that the only bar up there that's not in a bear market is the total stock market, and it's close. The active bar has actually been fairly close to the green not so long ago, but it has been quite a challenging year, especially with the faster growing, more speculative companies. And we are in danger of a long winning streak coming to an end. We'll hope that doesn't happen. I am reminded, Ken, that I think it was 2 years ago, we saw an amazing shift between mid-September and Halloween, to the point where I think we had like a 30% lead over the market that almost went away in that time frame. So maybe we can get a reverse of that condition this time around. Let's hope for that. I do find Superior Group is amazingly disappointing, because I think the company still continues to fire pretty well. iRobot and Boston Beer are kind of stuck in the middle of that group. Some of the decisions that we've made have been quite good, including Ken's selection or addition of InMode just a few months ago. That's actually kind of saving the actively managed group. But it's painful, but we'll continue to hope for the best and a good closing 6 weeks, and let's see what happens.
Well, everybody, all the people that are supposed to know tell us that the first signs of real life in the small caps will be the flea, or whatever you want to call it, that tickles the bear to death. It'll be the start of the new market when the small caps wake up and begin performing, and they tend to be some of the earliest better performers as a bull market takes root and takes off. So we'll see if that is the norm for this particular market turnaround, and I still have a lot of faith that the market will turn around. It's done it every single time that I've been in this position in my investing career, and that goes back a lot of years. I can hold the hands of all the folks that are under 35 and tell you that it feels terrible for quite a while, but it does turn around and you feel real good about it at a certain point.
And you got to be in it to win it. So that's why we do it. All right. So with that, Ken wanted to actually roll out some of the stocks that we are beginning to percolate. And these are just simply there to say we have noticed these companies for further study. So would you like to describe your 3 contributions, and I'll follow up then, Ken?
Well, I love them. Fox Factory is up near the upper limits of our size qualification, or our what we're thinking of as a small company. Last year we went up to around 1.5, 1.6 billion dollars in sales, and Fox Factory's at a little bit under 1.5 in the last fiscal year. I like it because it sells to a lot of customers, and it doesn't sell completed pieces of anything. It sells parts. It sells high performance parts for all kinds of vehicles, all kinds of things that are involved in setting records for the most part. If you want to get into off-road racing, for example, your off-road racing vehicle probably is loaded with Fox Factory parts. They make some of the most highly recognized brand names for actual professional participants in a lot of these different gaming situations, whether it's off-road vehicles or things on the water, or well, go to their website. You get a huge list of the kinds of parts and the brand names they're associated with. Metropolitan Bank, a pretty small bank, and enough said. I still think that banks are going to come out of this smelling pretty well. And Metropolitan Bank is on the short list of banks that I'm looking at right now. Descartes, this is a foreign company, so this is an ADR. We're looking at this DSGX, and Descartes started as a software company. It's moved into software that's a little bit different than it was originally dealing with, but it still does organization and backroom planning for a lot of things, but it seems to be focusing quite a bit on logistics and on getting things from one place to another in a very efficient manner. Again, a pretty easy to understand company if you look at the presentation out there on the Descartes website. I'm going to add one more name to this, and it's MXL. And Max, give me the name again, Mark. Max.
I think it's MaxLinear.
MaxLinear, that's right. I would suggest that I've never seen a regular value line sheet for a company the size of MaxLinear, but boy, does it seem to have in place all the characteristics of an emerging small cap ready to take off and move into this what we call the explosive growth stage. We've been talking about this on Bull Session, this model for small companies that are taking off. The value line analyst that is following this, and they have a regular value line sheet that you should go to and take a look at. The regular value line analyst is predicting earnings growth from the current somewhere around 35, 40, 45 cents in the last fiscal year, which was only the second time the company had been profitable. They're predicting growth up to around $5.50 3 years from now. That's more than 10 times earnings growth in 3 to 5 years. That's certainly aggressive. And this guy is willing to sign his name to the sheet, and Value Line's willing to put it into their what I've always experienced as critical thinking set of pages, kind of cautious, certainly a little bit on the conservative side. Mark and I many times have questioned whether they really get the idea of some of these small companies. So maybe this analyst is way out there. But again, another company I think you want to just take a look at and see what you think for yourself. They don't operate with consumer goods. They're operating selling what they do to OEMs and to second and third level suppliers to other industries. So it's not something you're going to come across in a consumer store, but it is in the semiconductor industry. And you might want to ask yourself if it's not finding a sweet spot where it's going to be a small cap company we can look back on in 3 or 4 or 5 years and say to ourselves, "Oh, we caught that one at the right time." So give it a look, you know.
Yeah, and I'm just reminded that you're kind of discussing a lot of the Feraldi stuff, but also that form of investing, which we sometimes refer to as launchpad investing. You know, catching that company at the right time. And if you search on Manifest for either the phrase launchpad or broad assets, that's the name of the investment club in St. Louis that kind of inspired it. And it's broad assets, BROAD assets. And they actually wrote a couple of those type of companies to many of their wins. They're a 3-time winner of the group entry for the Groundhog Challenge. So I took your results, Ken, and just kind of did a really quick screen to see what companies might pop up with a growth rate of at least 12% while exhibiting high quality and an attractive return forecast. I think I used a manifest rank greater than 95. There were a couple companies in there that, like Google, that I set aside because of the size. But LFUS is going to be a similar size to Fox Factory. So if we're going to go up to probably approaching as much as $2 billion this time around, that'll open it up for companies like this. Both LFUS and Fox Factory have been featured at recent roundtables. So you can actually catch them at on the YouTube roundtable broadcast if you want to go back and hear some of that. Cy Lynch presented LFUS a few months ago. It's been a very solid performer, and it's definitely a good story, and it's worth a closer look. And some really nice characteristics over here. So it's a good story. TREX, probably a stranger to no one here. PE is a little high, but you know, a lot of the stuff in the renovation side of things it would include a company like TREX, and might be worth a closer look. That also is going to be, I believe, in that $1.5 billion range for size. So might want to take a closer look. And Kornit Digital, I'm not familiar with exactly what they do, but I will be. And they made the list for somebody that might be worth a little bit closer look. So at least the list is started, and we will begin refining that between now and Halloween. You are welcome to send us companies. Every year we're inspired to add a handful of companies that come from you guys. So bring them out.
Mark, I want to add CHPT to that list as well, because I've been hearing it from a number of analysts as I read and as I listen to analysis in the various media. Chargepoint has decided they work in vehicle charging stations. You know, we can talk ad infinitum about whether this is going to be something that actually comes to fruition and whether it's practical and whether it costs a lot. But I like the fact that ChargePoint has consciously decided not to actually build the stations themselves, but rather build the parts that go into all the stations and then sell those parts to a lot of the companies that are trying to put together the network of charging stations throughout the country. So they're kind of backing up behind the creation of these stations and saying, you're all going to need this part and this part and this component and this component, and we'll supply you with a lot of that stuff. So I'm fascinated right now by this very small company as well.
Okay. So we'll get things underway. Here's another quick moment of fun, sort of fun with dashboards. Louis Navalier's recent memo here on 10 small companies that basically are cheap that he would sell anyhow. And I was just curious how these would stack up from the perspective of quality and return forecasts. And also wanted to make the point, while we're in the middle of talking about small companies, and we say this all the time, I don't think you can say it enough. Small cap does not necessarily mean small company. And a lot of times small cap just means they're damaged merchandise. In some
Fallen angels. Yeah.
Yeah. Go ahead, Ken.
I just want to say fallen angels. That's all. I can see a couple of them on here that definitely are fallen angels. I would not consider them small companies at all. Yeah.
Yep. And sometimes, and we'll basically cover that here. Here's a quick look, and this it's just kind of an interesting capture. For the first thing I notice is that Navalier is aligning pretty well with us here. You know, considering all these companies fairly low when it comes to quality, and this is where you can get tempted. And that's why I put the note on there about what is a value trap. A value trap is something where the price appears to be very attractive compared to typical levels, but the quality renders it quite a speculative, certainly non-core investment if it is a decent situation. But I also wanted to use this as a place to point out, this is actually kind of cool. You've got these extremely high projected annual returns over here. We'll reconcile them with this column here. And then just wonder if that isn't poking you in the side saying, you know, some of those are probably really too good to be true. Maybe targeted for virtually unachievable things in order to get from some of these results from this column versus this column. So I find that kind of fascinating that kind of jumps off the page. I also found it kind of fascinating. I think that might be the largest discrepancy between the Morningstar analyst on their price to fair value and the analyst consensus for 1-800-Flowers. That's a huge difference of opinion. And Matt Spielman and I looked it up. That 1-800-Flowers is 5 analysts. So it's not a matter of, one-on-one. That's a 5 analyst opinion right here. So kind of fascinating that there would be that wide of a divergence of opinion, but it's also interesting when you see this number. So could make for a pretty decent study. I mean, if there's one company on here that might not belong, I don't know. Could be this one.
Well, you wonder about the last column also, Mark, that those numbers just seem like they're almost like they don't have any meaning to them. I mean, I'm looking at some of these 1 year total returns, 354% for Express. I think that's a clothing retailer, a women's clothing retailer, isn't it?
It is, and it stems from the fact that they are down to $1 here. And so what you're basically looking at is the answer to the question, if these guys continue to draw oxygen, this might be possible. But they also might go horizontal.
Yeah.
And basically
maybe that's giving us a real good reason why the original rules, I guess, that came from Forbes for a lot of this, looking at the best small companies, stipulated that you should stay at least at stocks that were selling at stock prices of $5 or better. That's another column that strikes me as having something that you don't normally see, all these single digit stock prices.
Yep. So interesting. So again, the concept of a value trap. I love Louis Navallier for the discovery of ideas. Sometimes I scratch my head over portfolio management, but that's a discussion for another time. He is a good source of ideas. All right, so I used this next topic as an excuse to get out the cartoon or the Marvel characters one more time, the Guardians. And with that,
I'm all for it.
welcome.
I'm a Disney shareholder.
With that, I'm going to turn it over to our guardian of the galaxy, Matt Spielman. And Matt actually asked a question on the forum. So, Matt, why don't you take us away and just tell us your concerns and what you'd like to kind of kick around for a minute?
Sure. Well, as a little bit of background, so I was shopping for an industry for my club, the Houston Model Club's industry study for next month, and browsing in consumer staples, since we're in an inflationary environment, and they tend to be things that people continue to buy even as they get more expensive because they have pricing power to be more expensive. And started with Helen of Troy. Also went to Utz, of course. Had discussions here about Utz. British American Tobacco, not for me, but of course we know why people would still be buying those. And then came across UG, which I had no idea what it was. And so I started poking around at this. You can see from the headline here, right? High quality stock, 83 quality, very good par in the sweet spot. But I wondered what it was. Why hadn't I heard of it? And long story short, or maybe one other angle that I come in on this, I find it interesting. I think a lot about Manifest position or this community's position on Google. And particularly when we talk about and kind of follows along that small cap item, right? So Google is a gigantic company that still grows like a small company. And it's a good example to talk about what people mean by bigger or small company, depending on what your metric is. But what I found here is a very small company. And in fact, when we get on, we'll see how small, but it's only about 14 million in revenue. So micro company. But you know, how would that company get such a great quality? So that's the bottom part of this picture is it actually has good financial strength. It has no debt as such a small company, and that gives it some points on the board. Tremendous score on earnings per share stability, which we tend to think of, at least in some instances, we think of that as a shortcut for up, straight, and parallel, an idea that its earnings are going to be really good. And of course, the other two are industry metrics. Those are the two that are there. If we go to the next page, oh, you inserted one. Well, okay, so this is what they do. There's a number of brands you probably haven't heard of either, but let's say cosmetic ingredients, cosmetics and pharmaceuticals sort of ingredients, kind of like our discussion before, right? They're not making the things you buy, they're making things inside the things you buy, which can be helpful to diversify their business, but also drive the sales, right? So if one customer has some sort of issues, you're not really reliant on that. So that's what they do. Again, for about 14 million sales. Next slide. So this is section 1 of the SSG, and I looked at this and I said, well, that's not growth. It wiggles kind of back and forth. It does look like sales do drive earnings. It looks like their peaks and valleys match. 2016 being maybe a little bit extreme, where earnings was hit even more, but it doesn't scream out quality to me. And again, in the sense of if you have a small company with at least, in this case, 10 years of history that isn't growing, it's going to be small forever. And so should this be something that, one, Manifest gives a high quality ranking? Because the other thing we talk about, again, when we take shortcuts, when we talk about things, we talk about if you're looking for core investments, you want high quality, but this would say it's not merely high quality, that's still just the starting point. But also, should it even show up in the top ideas in an industry, or could it be dangerous for a newer investor who's using our data, the Manifest data, to help themselves filter things along? Could they get in trouble looking at something that might be more dangerous than it appears on the surface? That's it in a nutshell.
That's fair. And this is kind of what I came back with again.
Mark, could I ask you to stay on that graph one more time?
Sure.
I just want to add one more point to what Matt was talking about. I find it fascinating that this is one of the few companies where I can look at the visual analysis and I can draw a horizontal line through the eye bars that touches every eye bar. And I think I can maybe squeeze one in there that would do that. Now that's a very straight line if you're able to do that. A horizontal line is pretty straight. But I'm asking myself if just because it has that nice stability of earnings at around zero slope, whether it's worth any points on earnings stability. I certainly think that you need a line with a positive slope to make it appealing to an investor, and I don't think that I could come up with a very many examples where I can draw that line that you just drew and touch all the prices from every single fiscal year. It just I don't know, Matt, is that maybe part of the point that you were making?
Yeah, I mean, I was focused on on particularly the revenue growth, right? Because price follows earnings, earnings follows revenue.
Right,
But
right.
you can say that for everything, right? This seems
Yeah.
I mean, it isn't even straight. It's neither. It's parallel, pretty much.
Yep,
But it's not up nor straight.
Not very up.
yeah, yeah.
Straight and parallel, but not very up.
And maybe occasionally companies like this get caught up in our web of rules, and you don't take a moment to ask yourself, is this really an exception? I guess I'm asking in my normal teaching method, is that where we're going with a company like this, that it seems to have a high quality that maybe doesn't seem to be earned as much as a lot of other high quality companies that we look at?
Yeah, and one of the things that we have pointed out from time to time, and Chuck Allman used to find companies like this and prosper, incredibly over companies like this, and we have featured them. So that's kind of where I'm coming from. The other thing is, the Chuck Allman story is a great story, but also this notion that we do have to come at it from almost robotic. We're measuring these certain characteristics, and maybe that's what we take a shot at here. But I also wanted to point out, basically here's how we look at the company. And the first thing is, I do think that the forward expectations are important because they do give it a little bit more up than what is shown on that previous slide. You obviously, when you're studying the company, not just this company, but any company, you often want to emphasize the right-hand side of the chart, and do it carefully, do it with consideration, consider all the data. But what is happening out there probably is quite important. And as Matt suggested, fairly stable when it comes to earnings. So again, tiny company, where they are getting a huge amount of credit is coming from two places. Even for this teeny tiny company, the profitability is pretty rock solid, and it's also quite high. You're basically looking at 30 to 40% there, but 40% being a pretty normal number for the operating margin. It does not fluctuate around that much, so they get a lot of credit for that. And that, of course, boils down to the bottom line for net margin. So you got the profitability is high and it's consistent, and they do pay a pretty good dividend at anywhere from 5 to 8%. So it's not a growth company, probably not a core company for anybody, but could it be an interesting company? Sure. As Matt was suggesting, maybe it doesn't even get enough credit for financial strength because they have no long-term debt. And look at this situation. I mean, their total liabilities are overwhelmed by the amount of cash on hand that they have. In fact, they have paid a special dividend in the past. So sometimes they tack on some return there. So again, I would say, it looks better to me than what may have appeared on this page. I'm not saying it's the ultimate, but I think this representation of it actually does make it appear to be a little bit stronger. Is that more representative? I don't know. What are your thoughts?
Well, I think the only number that strikes that comes off of this that wasn't on the visual analysis is that dividend yield, and suddenly this has some interest to me in the, considering the market we're in right now. It looks like the dividend is fairly safe, considering the history and considering the amount of long-term debt they have and the cash they have on hand, and maybe this is a great place to run and hide with some money right now.
Having said that, though, our experience with the Sharps compliance and Superior Group, maybe those tough times that have gone by, it's just something to consider. And the other thing
George Mackey brought up is, again, considering the market size of the company, right? They trade just 8,700 shares a day, so about $100,000 a day. So before anyone in the audience jumps at it, think of how your actions on the company might influence the market at the time.
Yeah,
unless that's what you're looking for.
That's not much float at all, is it?
No, and it is something you want to be careful with. With a company this small, probably want to use not a market order, but some type of limit order. The other point is this would be an opportunity for all of us to band together and move the stock price. I didn't say that. I didn't say SEC. I'm kidding.
It's an unknown meme, right? 0 to 1 meme. Your question was great, though, Ken. I mean, it's a matter of, and even as an open question, I didn't know a direction I would go to. Is, should this change the way do we find that this marked as a high quality company is an error, and we should catch this as an anomaly, or is it simply a cautionary tale to say, no, this metric, like any other metric you could ever find about the market, is not the sum total of why you invest. Don't act on just that level. That's simply a trigger for your own research.
I think that's a much better way to approach it, Matt, and to understand that no matter what system you use to rank stocks, there are always stocks that are gonna sneak through that system that maybe don't match exactly what you had in mind when you devised the system. I'm certain that we didn't have, or that Mark didn't have, this type of stock in mind when he devised the quality rating. And yet the quality rating is there to tell us a little bit more than just whether it's going to be investable in the future, isn't it, Mark?
Yeah, and I think that leads right into this one. Here's another look at the company. Again, as Ken said, the price has been fairly stagnant over the years. The fundamentals have been pretty much intact over that time frame. But when dealing with beginners, and Ken and I have both brought this up in a very strong manner during classes, if you're looking for a tiebreaker, a financial strength rating of B for a company, especially in the face of what we just saw in terms of them having no debt and a really good handle on liabilities versus cash, the fact that they're only at B for a beginning investor, it's probably a nudge to be very careful out there, because you're basically talking about, and here's the value line definition, you're talking about something on the left-hand side, the weaker side. In other words, a B rating is below average. And you want to understand that. So as a beginner, maybe it's to take, not just one step back, but 2 steps back as you think about this company. Then there is a little bit more at the bottom of the page, the rest of the story. This company went looking for somebody to buy them in January. And they basically have completed that without finding anybody who was interested in buying them. So, factor that into your thinking. They're also losing a long-time president and CEO at the end of this year. So these are all things for a more experienced investor, some of the nuances and things that you might want to be aware of. But again, that relatively low financial strength rating is a real danger Will Robinson type characteristic, in my opinion. Anything else to add on this one?
This is an interesting stock to look at. Very, very different from what we normally see, and yet it sits up there with that higher quality rank. Nice job, Matt.
Thank you.
And I will now, for more of the rest of the story, disclose that their main product is that jelly, which happens to be used for certain exams in doctors' offices.
Okay.
And I'm actually more surprised to see, because a lot of those exams have been skipped and deferred over the last few years. Matt already pointed it out. You know, with COVID, this is down a little bit, but that could have been a whole lot worse. I'm referring to this product here, which is used for endoscopy and a couple other types of exams that men are familiar with. All right. Any other thoughts? Let's talk FedEx while we close down, because there has been a moment here in the market here over the last week or so. FedEx basically took their forward-looking estimates for the next year off the table, and several rhinos were seen to have seizures and lose consciousness. And you can see the stock price has dropped over 30% in a heartbeat. I don't get it. I do not see the same type of weaknesses that they're talking about. It's kind of a weird situation. And Matt, you were talking about witnessing kind of the opposite type of indicator this morning, right?
Well, it was also in yesterday's Wall Street Journal that a number of major shipping lines are actually getting into the air freight business as a way to be able to offer their customers a way around all of the problems they've had with delays at ports for various reasons, lack of containers and everything too. They were seeing an increasing demand for air freight at the same time that FedEx is claiming a big slowdown. Now that's commercial customers versus end customers, but that those 2 points still meet somewhere.
Mm-hmm. So again, just kind of scratching the head. Those two sound like they are at odds with each other, and I didn't hear Federal Express actually blame, increasing competitive measures or anything like that, other than part of the, as part of their explanation. So it's interesting. Probably keep a fairly close eye on it. I'm actually kind of a little surprised that there hasn't been a little bit more of a bounce back in the price from that deep drop. So kind of interesting. It's down at a relative strength index less than 20. So I think it is one of those moments for an experienced investor who's willing to take on a little risk to again, take a step back and decide if you think this is a fatal situation or one that this company has a pretty good opportunity to recover from. If they can stay on those trend lines, you are looking at some fairly rewarding return forecasts on that page. Any other thoughts? Or are we good to go, Ken?
I'm asking myself the question, Mark. What was the relationship between par and proof 6 months ago? We don't have that history, so I can't look back at it and everything. But it seems to me that the spread between those two numbers is reached a point where it's starting to get a little bit curious to me. And you know that I've been using proof to temper PE values. And I'm wondering if this spread between a 24 par and a 16.8 proof, if that's wide enough to temper the PE that I might use on my initial analysis, and maybe move it from 12 to something in the neighborhood of 11 or even 10.
Yeah, and the PE was 14, so
yeah.
It's already been trimmed a little bit. So
yeah,
and still ended up there. It'll be interesting to look at.
I don't know the history. I don't study FedEx in a regular rotation or anything, so I don't know the history of the difference between the two numbers. But at some point, the database is building that we can go back and look at that history, and that'd be an interesting exercise. But not for today.
Yeah, I actually have that information. I know that I bought FedEx approximately a year ago, so I can actually look back, and we can talk about that in more detail later. All right. Here's a reminder that we do archive all of these sessions, including roundtables and any other educational sessions that we do on the YouTube page. All you have to do is search for Manifest Investing. You should see a page like this. If you've not subscribed, please consider doing that. Join us, hit the subscribe button. We'll let you know anytime new content is posted. The one in yellow is a session that we've received considerable feedback on. That's the Olivia Newton-John session that we did a little over a month ago, that included the Peter Lynch analysis of how powerful a few good ideas can be. So it's a pretty good session, and a number of you have written to us and expressed your appreciation. And with that, that's actually a Minnesota sunset, not too far from the Field of Dreams, from Mr. Ron Thorson. Did you have something, Ken?
I just wanted to put a plug in for the book that we talked about 2 or 3 weeks ago, Mark.
Mm-hmm.
I finished reading it. And again, I'm searching for the last name. It's not coming to me.
It's Morgan Housel. I'll make sure.
Housel's book. I found it fascinating and an easy, understandable in language, straightforward thinking, enjoyable financial book to read. Many times I read these financial books and I read them out of duty, and I don't particularly enjoy the read. I get some information from it, but don't particularly enjoy the read. This was an enjoyable book, and I would recommend it. Housel's book, Hoessel, I think is the way it's spelled.
That's correct, and I'll put that on the forum, and it's on my desk to be read. I had to read a couple other books between then and now, but so I will catch up to Ken, but I have been a follower, and I've actually met Morgan a few times.
I would love to put his book on our agenda for maybe 2 or 3 weeks from now.
Okay.
Even if it's only to discuss 1 or 2 of the chapters. It's just so full of good, solid reasoning and things that really make you think.
We will take care of that. Thanks, Ken. And here's one from 2 years ago. I just want to remind that one of our themes around here is friends don't let friends be average investors. I just thought it was a good time for that reminder. And another trip to Donnelly's Irish Pub, Ken.
All right.
All right. So with that, any questions or comments?
Barb would like to know if we have any thoughts on Generac, and you've been a real proponent of Generac. Do you have any thoughts about it, Mark?
Yeah, I think the situation you're seeing right now is probably some supply side type stuff. They have had some service issues, but I think if you really take it as a long-term perspective, I am a shareholder. I'm a big believer in the weakness of our electrical grid. I'll pause to let that sink in a little bit. Yeah, I think that the proliferation of generators is a foregone conclusion, and they're the best at what they do. Any Costco shoppers can actually witness a Generac generator on the way out of the building next time you go shopping at Costco, as an example of where they are fairly ubiquitous, and that's all I have to say.
Okay, and that's the only question that I haven't been able to keep up with, so I think we can close up today and remind people that we'll be here again next Tuesday at 2 o'clock in the afternoon.
All right. Thanks, Matt. Appreciate it.
Very welcome. It's always fun.
All right. Take care, Ken. Talk to you soon.
Bye-bye.
Thanks, everybody.